Thursday, August 20th, 2020, Maneco 64, home of alternative economics and contrarian views. A few things today to talk about. The main one is that it's the Federal Reserve that's behind the coin shortage in the United States. The other point I'd like to talk about are the minutes of the late July FOMC meeting that came out yesterday. FOMC, of course, is the Federal Open Market Committee meeting of the Federal Reserve. The other one I want to talk about, other point, of course, is the CPI data for the UK that came out yesterday. CPI, of course, measures the price moves in the economy, the consumer price index, and it's a consequence of inflation, of course, but nowadays it's called inflation. I'm going to touch upon that. And of course, at the end, I'm going to quickly look at where the markets are. So for the Federal Reserve coin shortage, and to make it clear, the Federal Reserve is not involved in minting the coins. It's the U.S. Mint. The Federal Reserve is the issuer, of course, of Federal Reserve notes. So it's a liability in their books. But the coinage is an asset in their books because it's issued by the public. And by the public, I mean the U.S. Mint, which is part of the U.S. Treasury. So it's issued by another sovereign. And why am I saying that another sovereign? Well, because the Federal Reserve is the major sovereign these days. And I highly recommend you watch a video by John Titus, who I have interviewed on this channel. He's got his own YouTube channel called Best Evidence. And he's done a video overnight entitled, What's Behind the Fed's Manufactured Coin Shortage? The main points he makes is that the Federal Reserve and the mainstream media are saying that the reason why there's a coin shortage is because the economy shut down, so coins are not circulating as much. Even Jay Powell said that the mint is not producing as much coins, and that's why we have the shortage. But he totally discredits those views. He actually shows a clip of the head of the U.S. Mint saying that they've produced more coins than ever in 2020. And he also shows a senator, I think, it was a senator from Tennessee, saying that his constituent banks, the banks in his constituency, are complaining that the Federal Reserve is not sending them all the coins they request, because that's how the system works. The member banks in each Federal Reserve Bank district, when they need cash or coins, they will request that from the Federal Reserve. The Federal Reserve will debit their reserve accounts with the Federal Reserve Bank of that district and send them the notes and the coins. So the Federal Reserve is holding on to the coins. John Titus seems to think it's because the Federal Reserve doesn't like another sovereign, i.e. the Treasury, having control over the coinage, and the fact that they don't earn any interest on coins. They do earn interest on treasuries, of course. Yes, he doesn't talk about the fact that maybe the Federal Reserve doesn't want cash being used, but coins are not really cash, are they? Because cash under the Federal Reserve balance sheet is a liability. They issue it. Coins, they don't issue it, and they have to pay full face value for it as well. They don't earn any seigniorage. Seigniorage is the difference between issuing or minting the money or the notes and their face value. The Federal Reserve has to pay 25 cents for each quarter, not a cent, which is probably how much it costs to produce it. So I found that very interesting. There's been a lot of debate about that. So I'm going to put a link below in the description to John Titus's video, and I'm going to put it up in the cards as well. So now to the FOMC meeting. the minutes, of course, because the meeting took place at the end of July, and I think they wait about 3 weeks to publish the minutes. The markets always have expectations about what they actually said at that meeting. It's not even what they said yesterday, because it came out yesterday. It's looking backwards, I would say, as well. And I think the market had a little bit of a temper tantrum. Stocks went down a little bit. We saw bond yields go up slightly. We saw precious metals, of course, get hit hard. I've looked through an article here from the Wall Street Journal, and it says Fed sees need for additional support but is vague on timing. Minutes from July meeting show officials are close to finalizing a revamp of their long-run policy setting approach. I'm not going to go through the article. I've read through it, and I would say that the basic difference here between market participants, their expectations, and what the Fed is thinking is about timing. But as the article points out, the Federal Reserve is still 100% behind this accommodative policy that they have. Jay Powell has said many times that they're not even thinking of raising interest rates. And I think the market was expecting them to have talked about capping yields or yield curve control, and they didn't talk about that. But at the same time, I think what the Fed is doing is they're just waiting for the right time when they need to do it, because yields are still fairly low, as we will see later on when we look at the markets. I think the Fed doesn't want to waste any ammunition for when things get worse in terms of the crisis. And they're just waiting, because we saw earlier this year, a few months ago, when they announced all these alphabet soup programs, aside from all the QE, that the market actually didn't even wait for the help from the Fed. They just did it themselves. So I think that's what's going on. I don't think the Fed's going to change anything. I think they're in it for the long haul, and they're going to start when they need to. And I think the market is thinking backwards. They're thinking like it used to be before the crisis, that they needed guidance from the Fed, that they were going to keep rates low. But as the article says, they don't need any more guidance, because the Fed is fully committed to low rates, zero rates, and doing whatever it takes. So I'm not concerned. Well, I am concerned, of course, because this is inflationary, and it's not good for the currency that people hold. It's going to create more misery, more inflation. It even talks about that the Fed is looking to change a statement about their 2% target, that they could run above 2% to make up for the times that inflation is, or CPI is, lower than 2%, which is ridiculous, because you'd think lower prices would be good for people, but the Fed doesn't think so. So with that, let's jump to the UK CPI, RPI, or inflation data that came out yesterday. So I saw an article from Reuters. It says UK inflation jumps in July as clothes shops shun summer sales. So you see the mainstream media, mainstream economists, they blame shops and businesses for a lack of inflation or for inflation. They don't realize that inflation is purely a monetary phenomenon. And it says here, the article, British inflation jumped unexpectedly, which is ridiculous. For me, it was not unexpected, because, and for you, it's probably not unexpected as well, because if we've looked at the M2 figures for the UK, the Bank of England's balance sheet increasing, that is inflation, right? Last month, to its highest since March, as clothes shops did not hold their usual summer sales when they reopened after the coronavirus lockdown, but most economists expect it to fall again soon What do they expect to fall? Well, they expect the CPI to fall, which they call inflation. I've done many videos about this, and we've seen Peter Schiff and Jim Rickards debate about this. I'm on the Peter Schiff camp, of course. So the other fallacy is that a weak economy, an economy in a depression or recession cannot have higher prices. And we've seen that that's a total fallacy. It's usually in a weak economy during a depression that you even get loss of confidence in the currency, which leads to hyperinflation. So let's see what Reuters says. They say annual consumer price inflation. Well, that's a fallacy as well, because CPI doesn't stand for consumer price inflation. It stands for consumer price index. Rose to 1% in July versus 0.6 in June. So it doesn't sound like much, 1%, but in markets, it's all about expectations. That number was expected to rise by 0.6. It rose by 1%. And many years ago, under the Labor government, they started targeting this CPI because RPI was the statistic that was used to measure prices, the retail price index. And they still publish that, but it's not really looked very closely at. And that one was expected to rise from 1.1 to 1.2, and it came out at 1.6. So that's the one that I would say is pointing to a lot higher prices. And I would say that these statistics are doctored, much like the COVID statistics have been doctored, as we know. They've had to make revisions on that matter. I think they had to revise the deaths down by 5,000, not because people resuscitated or rose from the dead, just because they, for some reason, put too many people dying of the virus. So you can't really trust government statistics. But the interesting point about this is that everyone is surprised. It's unexpected, right? But for you and I, it's not. And that's why we're doing what we're doing, accumulating precious metals. We know that the only way that the British pound and all other fiat currencies are going versus real things, and especially real money, is down, right? So now let's look at the markets. It's 8:45 a.m. London time. We've got spot gold at $19.43. It's up $14 or 0.73%. Yeah, very volatile still. The low overnight and yesterday was around 19.25. So that 19.20 level is still a support. Could we still go back below there? Yeah, it's possible. Does that mean the bear market in fiat currencies or the bull market in precious metals is over? No, not one bit. I think things are getting worse in terms of the economy, not only in the UK, but in the US. I got a message from one of my viewers yesterday. He lives north of Washington, D.C., and he told me a friend of his who has a very good job at a Fortune 500 company. He's in IT programming, just lost his job. He said things are not looking good when people like that are losing their jobs. So I think things are getting worse. And we saw as well recently one of the big retailers here, I think it was Marks and Spencer's, announced more job cuts. Silver is up 32 cents at $27 exactly, so up 1.1%. Range has been 26.57 and 27.50. Those of you who have been in precious metals for a long time, or maybe not even for a long time, you need to know that it's going to get even more choppy, and you need to just hold on. Hold on to the bull and be patient. Patience, I think, is the most important thing right now. You can't let the up and down moves distract you. You got to focus on the long term. Do you really want to get rid of your insurance, monetary insurance. And yes, gold and silver are money. They're not really insurance, but under a fiat currency system, they become insurance, if you know what I mean. Stock market, the Dow futures down 57.2%, 27,637. S&P futures down 9 points, or 1/4% at 3366. NASDAQ 100 future is down 22 points at 11,300. I saw yesterday a headline about Apple. Its market capitalization reached 2 trillion, which is almost the size of the UK economy. I think the UK economy is a little bigger per annum. And the interesting statistic was that it took from the early 80s until 2 years ago for Apple to reach $1 trillion in market cap. So it's doubled that in the last 2 years. So it's quite a big move. I think it's got a little bit to do with the national debt. It's more of a fact that Apple creates things that people want, things of value. Some of you might not agree, I know, but while the Federal Reserve and the banking system creates confetti, as I've said before. Currencies, yeah, we saw the dollar rebound quite strongly yesterday after the FOMC minutes and a little bit prior to that as well. This morning, though, things are a little more stable. The pound is down slightly at 130.86. The euro is up 1/8% at 118.55. The dollar is unchanged versus the yen at 106.04. WTI crude is down 2/3% at 42.76. To finish off the bond market, the 2-year yield is unchanged at 0.14%. The 10-year is at 0.67. That's unchanged as well. And I think yesterday when I made my video, we were around 0.66. Yields haven't really gone up that much after that the minutes came out. So I think the Fed is still on full throttle. They're still going to keep the printing presses running. Well, technically, it's the Bureau of Engraving and the Mint that keep the presses going, of course. They create all the reserves that flow into the banking system. And then the banks, with the excess reserves or the extra reserves they get, they lend out to the economy. That's how it works. And it's not going to stop. And it's the simple law of supply and demand. The more of something you produce relative to other things, the less value it will have relative to those things, right? So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all the other platforms below here. So Billy and I say have a great day and take care. Bye.